Alright, this is Ubaid on behalf of V Electronics, and in this video we're going to talk about a concept called financial panic. Now, when it comes to financial panic is a result of an asset burst. Okay, so as we learned from history, let's say the 2007-2008 recession, okay, whenever there is some kind of a natural catastrophe or whenever there is the lowering of interest rates, okay, let's say in an inflationary economy, okay, or let's say whenever the banks they start defaulting on mortgages and loans, let's say subprime mortgages back in 2007, 2008, okay, what's going to end up happening is, okay, people are going to go into what's known as financial panic. Okay, now what exactly is financial panic? So financial panic is a scenario where lenders they call back their loans. Okay, so lender may be the bank, it may be a credit union. Okay, lender may be a private lender. Okay, they will call back their loan to take advantage of high interest rates. Okay, so obviously, for example, when banks lend out money, okay, they will lend out money on a certain interest rate. Okay, now if the interest rate go up, okay, what's going to end up happening is, okay, the lender is going to say, hey, listen, I'm making more money off the current interest rates, okay, which means it's in my best interest to get the money back from the borrower and lend it again at a higher interest rate, okay, as a result of which, okay, what's going to end up happening is the borrowers will need to sell off their assets, okay, will need to pay back their loan. And when it comes to stocks, okay, people who invest in stocks, the investors will need to sell off their stocks. Okay, why? Because there's a callback. Okay, why? Because they need to pay off their debt. Why? Because they need to pay for whatever legal liabilities they may have. Okay, so this has to do with financial panic. All right, so financial panic has to do with selling off assets such as shares at a reduced price. And the reason why you want to sell off these assets at a reduced price is because, again, it has to do with interest rates. So high interest rates. Right? Again, lenders profit from high interest rates because when they lend money, say for example mortgages, okay, when they lend money, they're making profit off high interest rates. Okay, the higher the interest, the more the return on investment, the more the return on the loan. Okay, now this is one scenario when the borrowers or the investors will need to sell short, which means they'll need to sell off their assets right away. Okay, and the lenders will profit. Okay, however, there's another scenario where the expectation of future asset prices, okay, are low. Okay, so let's say in a rising market, okay, the expectation of future asset prices are high. So say, for example, real estate. Okay, if people are expecting real estate prices to go up, okay, they'll say, hey, listen, I want to invest in real estate. So when the prices go up, I can sell that real estate and make profit off it. Okay, if the gas prices are expected to go up, on the other hand, okay, they will start buying gas today to avoid paying higher prices in the future. Okay, to avoid paying more in the future. Okay, so this has to do with expectation of future prices. So this is another scenario, expectation of future prices. All right, now apart from expectation of future prices, okay, you also have, okay, what's called an asset burst, as a result of which, okay, you have other consequences of asset burst. okay, which means the prices of assets are generally going down, okay, because of high interest rates. People are, okay, spending less and investing more. Okay, why spend when you can invest money in your savings account and earn a higher interest for future investments? Okay, so that's the idea. You spend less because obviously the interest rate is high. If you need to spend, you'll need to borrow money from the bank in the form of line of credit, credit card, so on and so forth, personal loan. Okay, as a result of which you will end up paying high interest rates. Okay, so why spend when you can invest in your savings account and earn a higher interest? As a result of which, what's going to end up happening is, okay, the asset prices will fall. So this is another scenario. Asset prices will fall. So not only does the expectation of future prices impact, okay, the way people spend and borrow money, but also the current asset prices, whether it's the price of gas, okay, whether it's the price of shares or stocks, whether it's the price of real estate, okay? So this has to do with financial panic, okay? In a rising market, okay, we know the asset prices climb. People are expecting a bright future. People are investing in assets. They're spending more money. The economy is booming because GDP is growing. In a falling market, such as in a financial panic or when the asset burst, okay, when you have an asset burst, okay, what's going to end up happening is this is a falling market, as a result of which people are going to spend less, invest more. GDP is going to shrink because personal consumption goes down, okay? As a result of which, okay, the prices of assets will shrink as well. If GDP shrinks, asset prices will shrink, the interest rates will climb, okay, so on and so forth. Okay, so this has to do with financial panic. On behalf of V Electronics, this is Ubaid. Have yourself a great day.